What are ETFs? ETFs are also known as exchange-traded funds, and they're popular because of their low cost, the tax efficiency and simplicity. An ETF is basically a security tracking a commodity, an index or basket of assets like individual stocks. ETFs are baskets of stocks or other securities. Some are index ETFs and mirror the S&P 500 or FTSE or some other international index. Instead of having a fund manager meddle with the strategy, the original ETFs simply had a computer invest in the same shares as the index, at the same weights. Having an automated setup like that means that very little cost, and the fee structure of these ETFs is kept low. ETFs are a good investment tool that can be used to build a diversified portfolio quickly. The basic idea of an ETF is to shelter you from individual stock gains and losses, so as to average out a small gain that beats inflation. ETFs can also be used to segment part of your portfolio into various niches that really interest you. You buy ETFs from an investment broker or an online trading platform. ETFs are traded like stocks on the stock exchange, so you can buy and sell whenever you like. The intraday tradability of ETFs, which typically hold a basket of securities but trade like stocks, means that ETFs are a great tool for short-term trading, long-term trading, or even portfolio hedges. The advantage of an ETF over a mutual fund is that an ETF can be traded all day in real time, whereas an order to buy or sell a mutual fund happens at the end of the day. And this makes them ill-suited for reacting to breaking news, for example. There are tons of people using ETF as long-term holdings, including the biggest hedge funds in the world. Facts about ETFs. 1. You can buy or sell ETFs any time that the stock market is open. ETFs are traded throughout the day at the current market price. 2. The cost is relatively low, relative to mutual funds, unit trusts, etc., and it's simple to understand. It simply mirrors an index, a basket of assets, commodity, etc. If the index goes up 1%, its respective ETF goes up 1%, assuming that the tracking error is 0. 3. ETFs have ticker symbols, just like stocks. 4. There is no minimum investment amount. 5. ETFs are bought and sold like stocks, and investors may pay a trading fee, a commission, to buy and sell them. 6. Never paying a commission to invest in an ETF means that you can continue to dollar cost average your portfolio. By removing the commission from the equation, you don't have to worry about the costs eating up your savings. And this allows you to continue to dollar cost average in your investments each month. Fact number 7. Another upside is that you can trade in and out of ETFs during the day. You don't have to wait until the end of the trading day or the end of the next business day's trading day. And this is what you have to do with mutual funds. Fact number 8. Great instruments for passive investments. They take away the fund manager, which makes them cheaper, since there is no question of commission or fees. Fact number 9. Standard ETFs can be used for investing or trading, except for leveraged ETFs, which should only be used for short-term speculation. And fact number 10. ETFs only mirror the index, So theoretically, they cannot beat the market. There are various types of ETFs. A. Index ETFs. These are index underlying. B. Stock ETFs. Stock underlying. C. Sector ETFs. Underlying as a sector index or sector stocks. D. Commodity ETFs. Underlying as commodity index or commodities. F. Inverse ETFs. They have an inverse relationship with underlying. For example, S&P 500 inverse would gain 1% if S&P 500 falls 1%. G. Bond ETFs. Underlying bond index or portfolio of bonds. H. Currency ETFs with currency underlying. J. Leveraged ETFs, giving a leveraged return. For example, on an index, a 2x ETF would give double return or loss. Let's discuss the do's and don'ts of how best to trade an ETF. Don't trade in the first or last 15 minutes of the trading day. This is when trade desks have less transparency and markets are much more volatile. Don't place market orders. If you want to trade electronically, place limit orders. We advise investors to always use limit orders, especially in times of volatility. We also advise investors to not use stop-loss orders that turn into market orders. Don't be tempted into over-trading. Do use a limit order when trading electronically. This cannot be said enough. If you are new to investing, start with holding ETFs and then watch your ETF investments. Eventually, perhaps start trading, but accept that you won't always be right. The second point is especially important to focus on because many investors can make costly mistakes by simply throwing in a market order. Are ETFs better than stock trading? Not necessarily. With ETFs, you are trading baskets of stocks as opposed to single stocks. With ETFs, you reduce your individual stock risk. If one stock tanks, other stocks in the ETF will help mitigate that one stock's drop. But on the other side, if you have a hot stock, the other stocks in the ETF will dampen that one stock's gain. ETFs are mainly for two purposes: indexing, or what is called passive investing. The SPY is very popular for this. It trades like a basket of all the S&P 500 stocks. Or ETFs are used for trading themes. If you think real estate is the place you can invest in the VNQ ETF or IYR ETF, then if you think technology is hot, then you can invest in the XLK ETF, for instance. There are around 2,000 USA-based ETFs, so you can find one for just about any market niche that you are interested in. Many trade ETFs by trying to stay in the hot sector. Just remember, an ETF is only as good as its underlying index. If the index consists of liquid stocks, then its ETF will trade with reasonable spreads and minimal discount premium problems. My experience is that if you're a good stock picker, you can make more money in individual stocks. But ETFs are used by more and more professional money managers, and they are an excellent vehicle for the majority of investors.